Everybody knows the price of gold. The mindset is that you buy gold. In India, they go to the store, people actually come, and usually the mother who is helping the daughter pick out the jewelry will say that when she got married, what was the price of gold?
Tanishq had a degrowth in a few quarters, and then we saw the regional players actually having very strong growth coming out of the gates, right? Is it that we're seeing a growth coming more in the regional sectors, whether it's north, south, east, west? Because the regional players are doing much better than a pan-India player.
The one big change is the fact that gold has got seriously financialized. It's a very liquid asset. You can trade gold very easily, actually. What that means is that the number of derivatives contracts outstanding on gold have really gone up.
That means a lot of people can now trade on gold in the international market.
Yeah, that's right. It makes a lot of sense to have it in the portfolio, and that's how people think. The other is you can't take a share certificate and put it around your neck. Finally, you can wear the gold. It is also a part of your lifestyle in a sense.
So Unmesh, HDFC Securities have also initiated coverage on two gold companies from what I saw, right? One is Senco and one is Thangamayil. My question is, why these two companies and what have you seen in these companies that you guys have initiated the coverage?
I think recently what happened was that two very compelling stories started to come out.
Hey guys, welcome to Make Money Matters Season 2, India's smartest podcast on finance. I am your host Shashank Udupa, and with me is Unmesh Sharma, who is the head of institutional equities from HDFC Securities. So let's kick things off with a fun fact. Did you know that Indian women have one of the largest reserves of gold? In fact, some estimates even suggest that they own 11% of the world's gold. For Indians, gold is more than just an investment. It is something that is in our culture, in our weddings and festivals. Now beyond that, we also see that gold is a massive industry that is evolving right before our eyes. Now today we are going to deep dive into this massive sector of the shiny gold, and we are going to understand what are big companies doing in this space. By the end of this podcast, you as a retail investor will be one of the smartest people out there to understand this entire sector. So let's dig in. So, Unmesh, I want to ask you this question, right? Because everyone is right now talking about gold, and there's a lot of things happening around the world with respect to gold. So, I want to understand from a macroeconomic standpoint, what do you think is happening with gold right now?
Yeah, so look, if you look at the last 200 years history of gold, it's mostly driven by what's happening on two very big factors. One is uncertainty. The other is the economics, so as to speak. Now, what that means is that over a long period of time, gold has really been a hedge against inflation. And the other is that because the value is well known and entrenched in the mind of the people at large, it becomes a counter indicator to basically what's happening on uncertainty globally. The one big change probably that has happened since 2001, maybe 2001 to 5 kind of period, is the fact that gold has got seriously financialized. What that means is that the number of derivatives contracts outstanding on gold have really gone up.
That means a lot of people can now trade on gold in the international market.
Yeah, that's right. Without actually having to hold the bullion.
Physical gold.
Yeah. So while there were financial products, present in gold even from the 70s, but what happened was that actually if you see the amount of pump priming which happened in the economy from 2001 to 8, which effectively led to the global credit crisis as well, was also created a lot of instruments for people to play on gold. And in fact, interestingly, what had happened was that, if you see that there was a point in time where, if you look at the 200-year history of gold, whenever uncertainty goes up, usually, equity prices will fall and gold kind of holds steady or goes up. But in 2009, when the global credit crisis happened, even in a time of uncertainty, gold actually fell. Because of the financialization, because when liquidity was getting sucked out, it got sucked out of gold as well. Now, what I'm trying to say is that actually gold today has become an interplay of three different things. And if you put it in the context today, what you will find is that one is that there is a lot of uncertainty about US elections. There are 2 wars ongoing. I'm sure we all know the macro on that front. The second is that given the lack of understanding of where the interest rate cycle and inflation will go, a lot of the central banks have started to hedge their positions. So what they've done is that of the entire basket of what you hold for reserves, whether it's in China or India or even in the West, including in Europe, people are actually increasing the proportion of gold.
By increasing the proportion, you mean that China central bank is buying gold?
Yeah, that's
India
right.
also is buying a lot of gold.
Yeah, so is Europe.
Okay.
So as a result of that, the demand for gold has gone up. It's also something to do with the uncertainty. So one is uncertainty is high. The second is that because of this whole cross-currency, people are hedging their risk by buying gold. And on top of that, there is a slight offsetting factor that globally the demand for actually consumer confidence has been not that great, especially in China. Because India, China, followed by the United States, which is a country mile behind them, are the two big consumers of gold to be used for consumption purpose, for jewelry basically. And China is not doing that well. So if you put it all together, gold's going up because of those two factors, but not enough offset by the fact that consumption has dropped.
Got it. And with gold prices going up, right? This is something that a lot of people have asked me, that prices of gold are going up, right? That means the raw material price of gold is also going up. So if you look at the gold companies in India right now, their margin should actually get affected because the raw material price is going up. Yes, their selling price is also going up because they're selling at a higher rate. But how does that work? Because that's very confusing.
Yeah, no. So look, I've had a chance to live and work in the United States for some time. There's a big difference in the jewelry sector in most of the world versus what happens in India. Is that the pricing is done typically on a gold price plus makeup, what are called making charges, as they call them. While there, if you go to a Tiffany or a Macy or any of these and pick up a piece of jewelry, it's actually a fixed price. And there is, the making charge could be as high as 40%. Because what happens is that the people who are buying are not looking at the underlying price, they are looking at the design. They are really buying a branded product. While in the case of India, what happens is that everybody knows every day. And I don't think there is any other country where every single person, whether even people who can't read, will know the price of gold on the day. So when they go to buy, they know the price, and they won't pay more than a certain premium to that, which also means that they are attuned to adjusting. It's like a pass-through, broadly. Okay. So if you go on the day, if the price has gone up 3% and you're still a buyer, you'll pay 3% more. So in that sense, it does not affect the end consumer in a sense. What, however, has happened is that I remember I had actually initiated coverage on the gold sector when I was an analyst back in the day, is that I looked at many quarters of information from World Gold Council. And what we had found was that actually, unless the gold price spikes by 5% quickly, and then when people start to think it'll come down, or when it's very volatile and people get confused, people usually don't take their consumption back. They continue to buy gold.
Interesting.
And the very strong factor is seasonal. There are, I'm sure there are some in South India, but for example, there is Akshaya Tritiya, and then there is going to be now, before Diwali, all these festivals are there. Dhanteras. There are days when you just go out and buy, no matter what the price is. So what happens is that actually and then there are, a lot of gold is consumed, maybe 50, 60, 70% of gold is actually consumed around events, where people become a little bit agnostic to price again. You're not going to pull back because of gold price for a wedding, for example. And then there is the mindset that people, what happen is that when they go for an event, it's very interesting. In India, they go to the store and invariably one of the comments, this I have actually done in a store visit, lots of store visits, and I can tell you that people actually come, and usually the mother who is helping the daughter pick out the jewelry will say that when she got married, what was the price of gold? Everybody knows the price of gold when they got married.
So is this because India is such a market where we know that gold upar hi jayega, it'll never come down, and is that deep rooted in our culture that we will buy at any price kind of a thing that came out? But is it still a good price? Because it's huge, right? It's gone up quite drastically in the last few years.
So look, theoretically, price can come down. Okay. But, if you look at the portfolio that my mother had, for example, in the last 10 years versus what I had, okay, it's not really underperformed as much. Yeah. And for the risk that you take for that, it's not an yielding asset. You think that it will go out of fashion. You think, the next generation will stop paying attention to gold. All of these happen in short periods of time. But over a long period of time, am I saying that gold should be a very important part of your portfolio? I'm not saying that. But what I'm saying is that invariably the gold price in some shape or form in the Indian mindset has basically, one is the volatility is low and generally over a long period of time has gone up in line with inflation. There are periods of time when it doesn't do that, but it's shown to be rock solid. Plus, it's a very liquid asset because you can trade gold very easily. Actually, even though you have bullion, it's not very difficult to trade it. So it makes a lot of sense to have it in the portfolio, and that's how people think. The other is, you can't take a share certificate and put it around your neck. Finally, you can wear the gold. It is also a part of your lifestyle in a sense. So people don't look at yields. They look at long-term price performance. They assume that prices are not going to fall, which, historically, while I don't like saying that, but has been true. So at least in line with inflation. So the mindset is that you buy gold. And that is why, all of these businesses are thriving.
So this we understood from the retail standpoint. Now, how do companies, your big gold companies, manage this with the rising raw material prices? How do they plan for this?
Yeah. So look, what's happened is that there is a fair bit of history to this. Okay. And if you look at the way in which the sector has evolved, the way the companies think about gold is really, if you look at the last 40, 50 years of history, you will find that actually it started off by taking full exposure to gold. Now, what happens is actually when gold prices go up, it's not such a big problem. Just to put it into context, what does a company do? The company procures the gold, gives it to a karigar, who then converts it into a piece of jewelry. There's a design element to it and all of that. And then that comes to the showroom, and then you are selling it. There's a price gap. If the price goes up, not only are you going to be able to sell at the new price, which is what I was explaining earlier, you will get the inventory gain. So your margins actually go up. Because the customer is buying on the day of purchase, not on the day you purchase the gold.
Interesting. So he buys in bulk, so he gets it at a good rate.
Yeah.
And by the time it's made, designed, goes to the end product, and then by the time you buy, if the price goes up, his margin actually goes up.
Yeah, but this can also go the other way because the price could come off. Now, in 2008, after the global credit crisis, what I was referring to, there was a period in time, I remember in 2009. So if you, actually gold collapsed after equities. Now, what happened was that gold prices were at $14.50 or something dollars at that point in time per ounce. And because of this sucking out of liquidity from the system, there was a big risk off trade. And for the first time in history, in a risk-off environment, gold prices fell 30%. So gold came to like 1050, if I remember, or 1000, let's say 1050. Now what's happened is that if you're holding gold inventory, the customer now is holding you to the lower price. And because the prices have come down 30%, the volume goes up because people come to the market to buy. So now you are faced with a situation where you've taken a 30% hit on inventory, your making charges are like 10-15%. Not even 15, actually, 10%. So you've now made a big loss on your inventory. Now what happened was that in China, there were two very large jewelers who went bankrupt pretty much overnight. And that led to a risk-off trade on gold across the globe. And in fact, I remember that actually Titan price had actually collapsed at that point in time for no fault of their own. At that point in time, what investors started to figure out was the fact that actually all of these hedging mechanisms which are in place for the large corporates is actually how you want to be positioned. So what companies do is that they hedge their gold price and they position themselves as companies who are adding value on the making and not really taking advantage of the gold price increase.
Wait, so you're telling me that they pass on, I mean, even if the price fluctuates up or down, they're actually making more money on the making charge and things like that rather than the actual price fluctuation.
So in India, actually the benchmark is really Tanishq. They are the ones who created the sector, they organized, and also all the practices which came with it. So what they do is that they understand, there is a very famous saying that if you're 5 feet tall, you cannot cross a river which is on average 5 feet. Because there will be times when it'll go to 10 feet, right? So what they do is that while other jewelers were doing it, Tanishq really made it popular in the capital markets, which is to say that, look, we are not giving you gold speculation to the investor. What we are giving you is the fact that we are a design company, that people trust us, that volumes will grow, it's a secular market, so on and so forth. And hence, our intent is to create a branded company for gold. So what they started doing was that they started doing what in those days used to be called gold metal loan, which is not there anymore because it's changed. But right now the practice in the market is that what you do is that you actually hedge the gold price on the day you purchase it. And then on the day you sell it, you close that contract. So what happens is that entire gold price for a fixed fee, just like in the options market, you're basically able to give it away.
Like a derivative.
It's like a derivative, yeah. So you could do it in multiple ways. You could do it on the MCX, but that's a little bit more expensive. But then there are specialist players. There are banks like Bank of Nova Scotia and so on and so forth, who actually, and even banks in India who facilitate this, who actually take the price risk away from you.
So it is net zero. By net zero, I mean if the price of gold falls down by 100 rupees, they are covered by 100 rupees. Is that how it is?
In theory, yes. So, firstly, that assumes all your inventory is covered, right? And also, what happens is that it's actually a nuanced argument, because there was one time when even Tanishq had actually a inventory loss, despite the fact that they were fully hedged. Because what happens is that banks work only 5 days a week, while people shop on weekends. So what happens is that on Friday, the company is supposed to take a projection as to what. So I remember in 2008 or 9, there was this one time when Akshaya Tritiya came on a Sunday, and gold prices came down 5% on the Friday, Saturday for whatever reason. And they had closed their contracts on Friday night, and there was a record volume sale on that day. So on a price risk that you had taken, they actually ended up making a loss. So it's not like you can be 100% hedged, but that is a one-off. See, it's happened one quarter, and I remember it after 15 years. So you can understand that it actually doesn't happen as often. The other is that actually, very interestingly, a lot of companies like Thangamayil, for example, they have come up with this model where what they want to do is that if you keep your churn high, okay, your requirement for hedging goes down. What I mean to say is that if you focus on products which are fast moving, and if your inventory through the year is moving, say 5 or 6 times, you are actually not hedging for the whole year. You are hedging only for that short period of time. And one very interesting scheme which a lot of these players do now, everyone does it, is the advance purchase of gold. And it's very good for the consumer. So for example, if you decide that next Diwali I want to spend 12 lakh rupees on gold for, let's say, my wife or whatever, my family, they come up with these schemes where you do 1 lakh a month. Now what happens is that you've done an advance sale. Once a customer is with you, now that gold is going to be sold off you. But what you do is that you actually, the jeweler closes the contract at the prevailing price, which means they don't buy 1 lakh. They don't buy 1 lakh, which means 12 lakh. What they do is 1 lakh worth of gold is closed on that day. So the grammage is calculated as per that price and then delivered to you. Now what happens is that you as a jeweler are not taking the price risk anymore. The price is sitting with the customer. So all, Thangamayil, for example, is 35% of all their sales are advance sales. So what you will find is that there are multiple ways to hedge your price risk. You will still have some open position. As long as your net worth and your bank lines and your working capital limits from the banks is going to cover that, you're fine.
So to understand, I think most of the gold companies right now are design companies. I mean, the advantage is, in a sense, is design, because the price is fully hedged completely.
Yeah, so there will be different levels. Not everyone is 100% hedged. I think Titan aims to be 100%. Everyone else is at between 60 and 80 and moving towards 100. And invariably, smaller companies don't get these facilities easily. So then slowly over a period of time, as they get organized, they start hedging a lot more. So companies which are earlier basically bullion traders or converters then become branded companies.
Now, this is very interesting because I want to talk about the companies now in this space. As you said, there is some difference between them. And I know that HDFC came out with initiating coverages, institutional coverage on Senco, Thangamayil and all of that. So I want to understand, how does the landscape look with these players? Because now everyone is putting focus on these players, which are like the 4 or 5 big players that are there. So from your perspective, can you talk about what is unique, what is exciting, who are the key players you feel in the next 10 years would be like a big player?
Yeah, so look, what we like, I can explain. Okay, so with the exception of Tanishq, really, there is no real pan-India player. Okay, there are people who are trying to go places, but I think if you look at Thangamayil, for example, or for that matter, PN Gadgil, or even the unlisted PN Gadgil, there are multiple families, or for that matter, Kalamandir from Surat, which is another unlisted player. What you will find is that, what we found is that very much akin to real estate, that it's a very regional, play. The reason is because there is a lot of affinity on language and on designs with a certain place. So very often what we found is that when someone goes out of their core cities, normally it is to target the diaspora of that city from that state, so as to speak. So for example, Kalamandir opened in Vamanaripete is there here. So when PN Gadgil did, they did it in the Dadar Lalbagh area, right? Because there is a congregation of Maharashtrians here. And so when Kalamandir came they did it in Borivali because there are a lot of Gujaratis there. So that is the way to think about it. trying to go outside your comfort zone, there is so much opportunity in India to move from unorganized to organized. There is no real reason to do that. So the first is we like regional, which is why Thangamayil is there. There is Senco and so. The second is that it's really a balance sheet business, because we believe that these companies now understand that designs sell. So I don't think there is a lack of understanding on that. So what happens is that they have a right mix of how much is non-designed, basically machine-made chains types. That is more to do that is more to create the churn, the asset turnover. If you look at a classic DuPont, how do you split it up, right? If you do theoretically this exercise, DuPont model will have, what is your margin? How much can you churn your inventory, and what is your leverage? So these are the three elements. And that's exactly how you should think about in jewelry as well. So in terms of margin, the element is how much studded jewelry, because studded jewelry allows you to charge a premium a little bit more. And your design element. If your designs are good and people like them, they'll pay a slight premium, maybe 1 or 2%, but that's good enough. Leverage is the balance sheet, which is what I was talking about, whether you are able to hedge and whether you have the bank lines to be able to support your growth. And then there is the third thing, which is the asset turnover. So there is a mix in that. One is the branded part, which is going to move slowly, but it'll give you the margin, and the other part is the things like machine-made chains. So that is how we break it down. What we like is we like regional focus in general. Tanishq being the exception because of other reasons. The second is that we like high turnover because it reduces the risk on the balance sheet as well. And the third is that we want to see the adequate amount of debt. We don't like debt-free companies, honestly. There should be some, there has to be an aspiration to grow. So if you put it all together, so we've just put out a report recently on Thangamayil. So that's the one that we have recently been pushing.
So two questions I have here, very quick ones. One is, you said that we like companies with debt. Now, this debt you're talking about, is it for store expansion kind of debt, or is it for inventory kind of a debt? What is it? Is it working capital, or is it long-term debt for store capital? What do you guys...
Yeah, so see, it's a classic retail model, but it's very interesting because what happens is that if you look at jewelry retail versus something like apparel retail or maybe even general retail, right? The cost of inventory is a huge part of your balance sheet. Actually, if you think about it, if you want to put 100 kilos of gold into a store, the store capex, the furniture means nothing in that. So everything in debt is related to the inventory of gold. Invariably. There will be some debt here and there for corporate office and so on and so forth. But debt is usually not used for anything other than the fact, because your balance sheet is just so heavy on inventory. And which is why inventory turnover becomes the single most important. If I have to use one line, I have to say how inventory days. You look at the working capital, that's all. If the working capital is okay, the company is generally all right. Even if you don't look at the P&L and you have only that, you should be okay. So debt is really has to be attuned to that.
And who in the industry today has a good inventory turnover rate, and which company do you see improving this? And what is the average that is good? Like, is it 30 days, 45 days? What do you feel is good?
No, so look, the holy grail I have found is that if you are turning your inventory around, I'll talk about it in year terms because that's how the industry looks at it. If you are over 5 times, you are generally very good. So that doesn't mean you sell bullion and do it 5 times, okay? So there is a balance between you doing 5 times, 6 times, 7 times, 8 times, and you getting the margins at... So what I found a rule of thumb is if you have 10% margin, gross margin, which means there is enough of a design element in your product. And if your inventory is turning more than 5 times, you are a well-run company. This is your rule of thumb. There is no... It's not like I cannot sit and scientifically show it on a DuPont, but broadly all the numbers will start falling into place. I think Tanishq does a great job, though I feel that somewhere with the, there is, some of the numbers have gone sideways for a while. So, they need something to happen now.
Growth has slowed down a little bit as well.
Yeah, I think some fatigue, size also brings its own challenges and so on and so forth. But Tanishq, obviously, great brand, great long-term story to own. But at the same point in time, that is one. But the regional guys like Senco, but really Thangamayil, I think they are the ones who are really improving. And what is happening is that this industry, as you grow, you get better anyway. Because what happens is that too many stakeholders have their skin in the game because you are financing your inventory. So the banking sector starts to take over, right? Then what happens is all the big private banks start coming in. And then, so the governance standards improve in any case, as with size.
Yeah, and this is something we noticed recently, that
Tanishq had a degrowth in a few quarters, and then we saw the regional players actually having very strong growth coming out of the gates, right? Is it that we're seeing a growth coming more in the regional sectors, whether it's north, south, east, west? Because the regional players are doing much better than a pan-India player.
Yeah, so if you look at the phase between 2010 and maybe 2020, 21, what happened was that there was a lack of trust in the gold system. So Tanishq was bringing trust to the table. If you look at the two phases and the latest one of hallmarking that has come in from, this is basically being driven by the government. What's happened is that, so Tanishq had the spread, they had the trust, and then they had the designs. The designs were available with the best quality regional players as well, especially because they were also attuned, they were also tuned to the local population. Hallmarking has become a game changer in two things. One is it helps move from unorganized to organized, which is a benefit for everyone, including Tanishq. But even bigger for someone who is much smaller, because then you are growing on a smaller base. If you have 10 stores and going to 30, you are growing 3 times, right? But if you are 100 stores going to 130, you are adding 30 stores, but you are not growing as much. So there was a little bit of that base effect. So what happened was that regional players already trusted started expanding with hallmarking. So some kind of backstop on the quality of gold, I think, has led to this huge shift from unorganized to organized.
So Unmesh, HDFC Securities have also initiated coverage on 2 gold companies from what I saw, right? One is Senco and one is Thangamayil. My question is, why these 2 companies and what have you seen in these companies that you guys have initiated the coverage?
Yeah, so we've been covering Titan for a while. So what we did was that I think recently what happened was that 2 very compelling stories started to come out. One was what we were talking about, which is the regional play. So you're looking for solid regional players. And we found that actually of all the players, these 2 really stood out. Now, there are some common elements within this. The first is that both of them are beneficiaries of the whole hallmarking story. So, this whole move from unorganized to organized really got... The second is that actually the revenue growth story is very strong because both of them, as they have become bigger, have been able to get risk capital, so as to speak, from the banks to be able to finance their inventory and hence move forward. And the IPO obviously helps because then your net worth that becomes that much larger. The third is that both companies, for different reasons, have very strong element of improvement of ROE. Now, why do I say that? So if you remember, we were talking about this DuPont model, right? Now, what happens is that in the margin part, Thangamayil has an improvement happening because of the fact that while they have very good asset turnover, their mix of jewelry versus chain-made is actually improved a lot. The other was that initially they were running a few, if I may call them, discounts to give the benefit to the customer for advance purchase of gold. So while it was helping them reduce the risk on the balance sheet, it was not that much margin accretive. But as that product has really caught on, what they have started doing is that those discounts have reduced marginally, which is something which will happen through the year. So you will see that uptake on the margins as well. So the balance sheet is getting stronger, the hallmarking is helping, and the regional players are really expanding. So this has led to them actually expanding their store base. In case of Senco, on that margin part, what's happening is that studded jewelry as a percentage in that regional market has really started to take off as well. And which is why I think both of them have very similar drivers, that they have very strong revenue growth, which is accelerating. The big beneficiaries of the macro, which is this whole hallmarking story. And the asset turnover continues to remain strong because of the fact that they're doing this only gradually.
Now, I want to ask you a question about the future, right? We recently saw Trent came out with this statement that they're getting into lab-grown diamonds. Now, lab-grown diamonds, we've been talking about it quite some time, but no big player actually took that step, and Tata, the house of Tata, has taken this step, right? So I want to understand what is so attractive about lab-grown diamond, and will this work or not work? I mean, we don't know the future, but how do you see this playing out in the market?
Yeah, it's a little tough one, but I'll tell you what are the drivers of why it's working. The first is that, when I initiated coverage on Titan as an analyst back in 2006, 7, it was. At that point in time, there was one theoretical argument on diamonds. One of the big arguments at that time used to be that as people start wearing more diamonds, diamond price discovery is lower because there's no benchmark. And De Beers used to control the global diamond market, right? So what happened was that the prices keep going up and you can charge a markup on that. So it's like a free margin, so as to speak. But at that point in time, a lot of theorists used to say that a diamond is not an element. So at some stage, people and the manufacturing process has been there for a while. It's not like it is something we have discovered now. It was just not being able to do it at scale. So what happened was that there was always this thesis that eventually diamonds are going to fall in value. One, because it's a supply constraint, unlike gold, which is an element. So it can go in and out of fashion, but it will finally stay. I think that has started to play out. What happened was that if you go to the West, if you go to a Macy's, for example, or you go to, I don't know, any of these Bulgari or something, the way they sell you a lab-grown diamond is to say that this is actually good for your carbon footprint. Because actually, because actually what happens is that the mining of diamonds is a very, very carbon intensive process, and then you have to transport it. So the transport is also. So if you, on a per carat basis, if you see the carbon footprint of the diamond is actually very high.
But that's why the premium, right? Because it was so difficult to procure it is.
But the mindset in the new, I remember, sorry, giving you an anecdote, my nephew once told me that he won't buy a big BMW because it generates too much carbon or something, right? But when I was young, the aspiration was to buy a very big engine. So what happens is that this generation is changing the way they think about this. So one of the thought process is that structurally there is a demand moving in favor of something which has been grown in a lab because the carbon footprint is low. And because it has been manufactured, any commodity globally, if you look at the 400-year history of any commodity which you can manufacture, it eventually comes down in price. So lab diamonds will fall in price. Now, the question here is that when you're looking at buying a diamond, instead you buy a lab-grown diamond, chemically they're exactly the same, right? Because finally the carbon structure is the same. But is that really a sign of whether you want to give it on a special occasion to, if you're proposing to somebody? Would you really want to do that? We don't know how people start thinking. There is a school of thought that people will go carbon neutral, and the others who say that the real thing is what we need. We don't know that. The second is that while a few others like Goldium have also tried it in India, the jury is out right now. Because as of right now, we don't know whether customers think of this as a cheaper way to own a diamond, or they think that if this has come to this level, it's become worthless. So it's a little early to call. It's an interesting one. I think what people are doing interestingly is that they have taken this model out and put their own stores. Instead of trying to dilute their main brand, they are all trying to set up separate stores to be able to do that. So the experiment is on. We'll see where it goes. I see the point for fashion jewelry, because then you can have a higher churn in the jewelry portfolio, so as to speak, because diamonds, then you have to
They'll have to do it similar to what people are doing in the West with Macy's, Tiffany's and all of that. It has to be designer-led, Designer-led with huge margins if it plays out.
Yeah, but then the alternate question to that is then why not just buy those old American diamonds, because they look the same. So if you're just looking at something, then why do you need a chemically correct product? So it's difficult to call right now. But it's interesting. It's going in a direction which I had never foreseen that people will be worrying about their carbon footprint, because diamond in essence is also carbon only. So you never thought that it will go like this.
Wow, very interesting. I think, guys, this is something very interesting that I've understood today, which as a retail investor I wouldn't have understood very easily, because as a retail investor we look at growth of the revenue. We look at what is that SS, same store growth rate. That is something we look at, and we say, okay, company is good or company is bad. But I think today something that all retail investors would have learned is what you said, which is look at the gross margins, start looking at the inventory turnover days. At least 5 times turnover would be a very good rate. And regional players are now doing much better with hallmarking kicking in as well. So we see that regional players are doing well, and that is why we see the premium coming in these players also in the stock market. So I think this is something that I think all retail investors should also take off this. Don't just simply look at the revenue growth and all of this, and also start looking at the jewelry mix. That is something that is also doing really well. Yeah. So that is the main part of today's episode. So if you enjoyed this episode, don't forget to click on the like button and share this with your friends who would benefit from this amazing podcast series. Also, don't forget to click on the red subscribe button so that you can stay updated with more episodes coming up on the Make Money Matter podcast. You can also follow the show on Spotify, where we will update the latest episodes there as well. Now, one of the most important things about all these episodes is that we had experts from HDFC Securities giving you deep, valuable insight and knowledge. And all of this knowledge can be found in HDFC Securities reports as well, which is there in the description below. Now, these research reports are completely free, and they offer you in-depth knowledge about the entire sector, which will also make you extremely financially smart. And finally, the most important thing is that you need to make money matter. So stay tuned for more episodes and drop a comment below on what you think the next topic should be.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.